Our next guest. Joining me right now, David Stryzewski is with us, CEO, Sound Planning Group, to give us his thoughts on the market, the outlook. How are you feeling? I think that today, some of the people are talking about the JOLTS report. So fewer job openings because maybe companies are worried about a possible recession. And what will that mean for the Fed? Will that slow the Fed from hiking rates? I don't know. What do you think?
Yeah, well, I mean, it's an interesting thing. I mean, the Fed obviously is getting some of the information that they're looking for, seeing, fewer openings available. Now we're down to about 1.5 openings per person that's seeking right now. That's a lot better than the 2-to-1 that we were at before. But we're seeing a lot of revisions right now in these job openings. And so I think that that's an important thing to note as we look back even over the last 8 months here. We're looking at about a $45,000 employee revision on a month-over-month basis.
Down.
So down.
Basically, it was fewer jobs.
That's right.
And so that could tell the big picture that a lot of these employers could be just tightening the belt. We'll see what they say. In the meantime, investors have enjoyed a good week and a couple of days, right?
Yeah, absolutely. In fact, we've had an amazing first half of the year. I mean, other than basically August here, it's just been nothing but sunshine, specifically in the NASDAQ. But, we're investors today are, looking at the markets and they're trying to interpret what's going on. And I think that this is a moment where FOMO is actually, really playing out right now, this fear of missing out. And we can understand that by looking at the Shiller PE ratio. The CAPE ratio today is something like 55% overvalued. And so if we look at that, that's an important indicator, as the next 10 years would note that based on those levels, we're going to have negative returns over the next 10. So, where are we at in this moment? I mean, I vote it goes up forever, but here's the reality. What goes up ultimately comes down. I think we need to be prepared for both sides of that. All
right, so that means that we're up for some negative news ahead. That being said, you have to assume that we're going to think that the Fed is honest in what they're saying, rates higher for longer. So you likely won't see any rate cuts this year, maybe next year. So what do you tell investors now? There's a lot of folks who have cash on the sidelines and or have made some good money on tech this year. What's some of your advice to investors these days?
Yeah, well, first thing I'll just note regarding the Fed in general, when the Fed is not going to speak to Congress about their spending, I think that that's a big mistake. When we continue to print and overspend right now, we're at $2 trillion of a deficit, and we're in the middle of peace. This is not wartime where you might see something like this occur. I think that that's a really, really big point for pause. When we understand inflation is literally created when we print. So that is a very inflationary thing that Congress is doing relative to what the Fed is trying to accomplish. So I don't see the Fed dropping rates anytime soon. Personally, I think they could even go as high as a whole 1% higher, because they don't know what the terminal rate ultimately is. And I think that we're going to run out of time if Congress continues to spend and they're continuing to try to contract. Where should people go right now? Well, there's a few things to try to understand. There's 5 things that move the markets. We've got the interest rate environment, we've got inflation, we've got what the Fed's doing about it, corporate earnings, and then geopolitical events. I'm actually seeing warning signs in all 5 of these.
Right.
So this is a time that we want to actually be a little bit more cautionary in our approach to things. Buy low, sell high. And so this is a nice time to be taking some earnings, some profits off the table. So where do we go? I look at assets in 3 different categories: cash assets, protected assets, and risk return assets. So we need a certain amount in cash. And by the way, if we're at the top of a market cycle, cash isn't a bad place to be, especially if you can get paid 5% on 6-month commitments of money, or somewhere around 4. Next is protected assets. Big warning though in this way, and that is, do not load up in bonds. There are 5 different ways that bonds can lose money, and I'm concerned that literally all 5 of those ways are actually on the table right now. If we have corporations that have impacts on their bottom line, Chapter 11 show up because of bank challenges, more difficulty getting funds, the cost of capital's increased. We could see big issues with that. So in my opinion, there's never been a better time to own something called a growth-oriented fixed index annuity. And what it does is it gives you hedging power. as in none of the downside of the market, but reasonable rates of return on the upside of it. And so these can be really good tools to be able to allocate in there. And then on the risk return side of things, of course we're going to be looking at stocks. There's definitely opportunities in this market to be making money. We need to be understanding, though, where are some of those places. One place that I think, Nicole, that people should be paying attention to are metal miners. See, gold right now is in a 12-year cup and handle position right now, if you look at the monthly charts. And so if it breaks above 2100, that would be the confirmation moment, and it'll go to 25 after that. But these metal miners are, if you look at their CAPE ratios relative to the S&P 500, completely different story. They're way undervalued. So I think that there's a great play in that. I think gold and silver are really important, but silver would be my lean above gold personally. And so just a couple thoughts on that.
Yeah, no, I understand. And so, I mean, you look at precious metals and miners overall, as you said, the CAPE ratio that you look at that gives you an indication of the next decade says a different picture than, for example, the S&P 500.
Right.
In the meantime, I mean, we're already seeing some, volatility, I'd say, in bonds because, they've been moving higher, they pulled back, and then just recently you saw, the long end moving higher, the 2-year was pushing 2-month highs. So if someone, obviously people are going to invest in fixed income, it's paying. Why not? What would be, you gave a warning on investing in bonds, but you didn't give a recommendation on what might work or not work, either short-term or long-term for investors.
Okay, so a couple things. Number one, so here's the 5 things the ways that bonds can lose money. We've got, when interest rates rise, it's the seesaw effect. So that's why banks are having such challenges right now. They committed all this capital to long-term treasuries that were at like 0.5%, 1%, and then now we're looking at, significantly higher. So we lose when those rates rise. The next is net present value. So the fees that we're paying relative to inflation that's going on and what we can get for those fixed assets. So if you can get 4, but inflation's at 4, and then you've got a fee of 1, well, you're losing 1. All right, so that's a way that we can lose money. Supply and demand factors. When the sellers want to sell more and the buyers want to buy, that's a way that bonds can lose money. If we go from credit worthy to less credit worthy, as we've been seeing some downgrades here recently, big expenses on that thing.
You're right about that.
And then, of course, the ultimate one is defaults. And you can look at Lehman, Bear Stearns. These were the definition of safe places to be in the 2008 timeframe, and they lost big time. So where do we go? U.S. Treasury is obviously the best place to go for short-term commitments and for capital commitments in cash. Way better than a bank that limits you at 250,000 FDIC. And of course, that's a lot of pressure on those banks because they can't compete with that nearly as well. But again, on the protected side of things, I think alternatives can be really important for us to be looking into. And some of those growth-oriented products that I was mentioning with none of the downside are my particular favorite right now, just given the math and science behind them.
Right, and you are worried about a recession. And how deep, how long, I mean, what do you think will happen? What are some of your, I know you have a base case and maybe a bearish case.
Yeah, I do. And a lot of what we've been analyzing here is kind of pointing towards the more negative case, and I do realize I'm more of an outlier in this way. I'm just trying to tell the facts of what's actually happening. Yeah. And so, recessions come and go, but global recessions, very rare. So we're looking at global recession right now. We're also looking at a financial crisis in banks. We're just in the first 5 months of that because it began in March. It took us 13 and a half months to get through the whole financial crisis this last time. So I think that there's more that's developing right now. And so this then gets us to a more of a rolling recession. And I think that because of the cost of capital and how that's flipped so significantly with the Fed's movement here, and we're going to be higher for longer, guess what? Capital markets affect everything. If we can't get credit, we need credit. If it's more expensive, that's margin compression on these corporations. That's going to show up in a very significant way. So as we're looking right now in September, historically the worst month for stock markets, as we're looking at the new college debt thing going back on, and new payments, and of course, a lot of people manage their money like the U.S. government. We don't actually budget. We ultimately just hope that there's enough that's coming in, and that's not really a great recipe for success.
And we've seen a lot of buy now, pay later.
Right.
And credit cards that have upwards of 20% for the rate, and the more and more you put on there, we have over $1 trillion in debt, as you know, for credit cards themselves, and people are digging in. So that's the part that's scary. For the parts you mentioned, cash.
Sure.
what kind of, there's sometimes when people come on and say, oh, we're 50% cash, we're 10% cash, we're 20% cash. And I know you can put in money market funds, but where do you think people are sitting in cash these days, or what kind of trends are you seeing?
I mean, it really depends. There's the people that want to beat inflation, they're all in and they have very little cash. There's people that are just very worried about recession and contraction,
right.
and so they're sitting heavier positions in cash. Now, the difficult thing is knowing when to deploy. And so if we know when to deploy, that's the $1 million question right there.
Yeah.
So it's difficult to answer that question right now, but I could say it this way. Many people that my firm serves are 65 and older. And so as we get closer to retirement or we get into retirement, we need more stability because we don't have the time needed to recover from some of those financial injuries that can come from these market crashes. So.
Okay, thank you for all of that. David Stryzewski, Sound Planning Group. Great to have you on.
Appreciate you.
Glad you were here. Thank you, David. Coming up next.